Bleeding Edge subscribers, hopefully you guys are doing well. So on Monday, we talked about how Wall Street expectations are going to be really tested over the next 4 weeks. And yesterday, we kind of got our first look into what happens when a company comes up short. Tesla, like all large automobile makers, they report their unit sales around the first of every month. And Tesla's March sales were nothing short of a disaster. The company reported negative sales figures for the first time in several years, causing Wall Street and investors to really reset expectations for the rest of the year. Shares of Tesla fell about 5% on the day and are down over 30% this year alone. Now, this is a classic case of a stock not meeting expectations and having Wall Street reset the valuation based on this new reality. Chances are Tesla won't be the only stock that comes up short over the next couple of weeks. That's why I'm declaring that the next 4 weeks will shape the markets for the rest of 2024. But really, what happens when a stock that you own or potentially want to own performs like Tesla did? Do you immediately cut bait and sell the stock? Or do you take advantage of the lower share price and buy? This is going to be a critical question that many investors face over the next 4 weeks. Today, using Tesla kind of as our base case or an example, I will give you a guide that you can follow over this next critical 4 week period that we're about to face in these markets. First thing we must do is determine whether the company's current situation is permanent. So, look, Wall Street analysts who provide revenue estimates and targets for public companies, here's a little hint for you. These guys are really lazy. Most rely on models or essentially an Excel spreadsheet with a range of estimates and outcomes that they have projected for the company. And you'd think most analysts would follow the news and adjust these expectations on the fly, but the truth is, most actually don't. One of my colleagues here at Brownstone Research actually says it best. He says if the data point doesn't fit into an Excel worksheet, they simply don't know what to do with it. And the truth is, Tesla's sales decline was more than telegraphed over the past 30 days. In March, Tesla's European factory suffered an arson attack that shut down the production in that facility. The company is also rolling out a redesign of one of its top selling models here in the United States. And the ongoing conflict in the Red Sea has caused critical components to be delayed. So while Tesla surprised the market with these poor results, most of it actually was due to the fact Wall Street analysts hadn't adjusted their models to reflect the challenges faced by Tesla over the past 30 days. In this scenario, I'd be more than forgiving of Tesla's decline because the challenges the company faced are unique and likely could be rectified later this year. But now the more important question that we have comes to the surface. Do you buy Tesla simply because the expectations weren't met? To be kind of brutally honest with you, the average retail investor would just snap and go buy Tesla. As we said on Monday, it's far easier to buy a stock that is down 50% than one that is up 50%. As consumers, we're trained to look for deals. I do it all the time. We're looking for sales. After all, who doesn't like saving money and getting a good deal? But this mindset really doesn't work in the stock market. Unlike something that you buy in a store, buying a stock is different. When purchasing a stock, you're investing in the anticipated cash flow, revenue, and profits the company will generate beyond expectations. And that last part is really the key and the one that most investors ignore. Tesla stock declined because it understandably missed expectations. For Tesla stock to go back up, it now must outperform those same expectations. How a company does this going forward is going to vary by industry and sector, but most companies rely on innovation. Over the past year, we've seen innovation in those GLP-1 drugs that are all the rage in kind of the weight loss communities, and they've sent shares of Eli Lilly and Novo Nordisk soaring. Innovation in artificial intelligence, AI, has sent shares of Nvidia, AMD, Supermicro, Microsoft, and many others soaring as well. Yes, companies can raise prices or cut costs to improve their financial figures. They can also buy back the stock or increase a dividend. But innovation is what provides those huge payoffs that most investors are seeking. With Tesla in particular, it's not really the electric vehicle that will provide that innovative growth going forward. EVs are amazing, but are simply not for everybody. Tesla will need its innovative energy and kind of storage business, and more importantly, its robotics business to really outperform above expectations in order for shares of Tesla to rise again. Just like it was difficult for Wall Street to pencil in a factory shutdown or supply chain disruptions for Tesla in March, it's even more difficult to project future sales of projects that really aren't generating much revenue for the company yet. Later this month, there'll be a number of companies that fall like Tesla stock did based on poor sales expectations. The critical question that you need to ask is, can the company innovate new products and services to beat expectations in the future? If the answer is yes, you've likely uncovered a stock that is worth buying. We'll certainly keep you updated over the next several weeks as many companies are reporting earnings in a very short period of time. It's a critical 4 weeks, and we'll be here to cover it for you on the Bleeding Edge. I hope you all have a wonderful day. We'll see you again later this week.